Starting your journey in the stock market in 2025 can feel overwhelming, but with the right approach, it becomes a manageable and rewarding process. The first step is to clearly define your investment objectives. Ask yourself, why are you investing? Are you saving for retirement, looking to buy a home, or seeking to grow your wealth over time? Your goals will shape every decision you make, from how much risk you take to which investments you choose. Once your objectives are set, it's time to assess your risk tolerance. Every investor is different. Some are comfortable with significant fluctuations in their portfolio, while others prefer more stability. Understanding your own comfort level helps you determine your ideal asset allocation. For example, a conservative investor might choose a mix of 50% stocks and 50% bonds, balancing potential growth with lower risk. In contrast, someone with a higher risk appetite might opt for a portfolio with 90% stocks and just 10% bonds, aiming for greater returns but accepting more volatility along the way. Next, you'll want to select a brokerage platform. In 2025, there are more options than ever, with many brokers allowing you to open an account with just a small deposit. When choosing a platform, look for user-friendly interfaces, transparent fee structures, and access to a wide range of markets. Take the time to compare features. Some platforms may offer advanced tools, educational resources, or even simulated trading to help you learn without risking real money. With your account set up, consider starting your investment journey with diversified options like index funds or exchange-traded funds, commonly known as ETFs. These funds track a broad selection of companies, helping you spread risk and avoid the pitfalls of putting all your money into just a few stocks. For instance, a popular choice is the SPDR S&P 500 ETF Trust, which, as of October 2025, is trading at $672.14, a 0.44% increase from the previous day. This fund provides exposure to the 500 largest companies in the United States, offering a simple way to participate in the overall growth of the stock market. An effective strategy for beginners is dollar-cost averaging. This means you invest a fixed amount of money at regular intervals, regardless of market conditions. Over time, this approach can reduce the impact of market volatility as you buy more shares when prices are low and fewer when they're high, averaging out your purchase price. It's a disciplined way to build your portfolio and can help remove emotion from your investment decisions. As you begin investing, staying informed becomes crucial. Follow market trends, read about economic indicators, and keep an eye on major news events that might affect your investments. For example, monitoring the performance of key indexes like the S&P 500 can provide insights into broader market movements. Remember, while daily market changes can be dramatic, successful investing is often about maintaining a long-term perspective and resisting the urge to react impulsively to short-term fluctuations. Diversification is another essential principle. By spreading your investments across different sectors, industries, and even geographic regions, you can help protect your portfolio from unexpected downturns in any one area. Over time, this balanced approach can lead to more stable returns and reduce the risk of significant losses. Finally, remember that investing is a marathon, not a sprint. The most successful investors are those who stay patient, stick to their plan, and keep learning as they go. Regularly review your portfolio, adjust your asset allocation as your life circumstances change, and continue building your knowledge about the markets. In summary, starting in the stock market in 2025 involves setting clear goals, understanding your risk tolerance, choosing the right platform, beginning with diversified investments, and continuously educating yourself. With diligence and patience, you can navigate the world of investing and work steadily towards your financial goals.